I want to dive into an incredible trading strategy that can potentially boost your returns, which is the put credit spread. Put credit spreads are a simple yet powerful option strategy that any trader can use in their portfolio. Hi everyone, it's Evan here from Hef Trade. Hope you're having a great day today. Now I know you might be curious about how they work and whether they're right for you. So let's have a chat and let's figure out the ins and outs of the put credit spread. Put credit spreads are a versatile option strategy that can be used in both bullish and neutral market conditions. That means if the market's going up, you can make money, and if the market's staying flat, you can make money. Some people even say if the market goes down a little bit, you can make money there too. The concept is pretty straightforward. We simultaneously sell a put option with a high strike price, and we buy a put option with a lower strike price. This creates a credit where we receive a premium up front for entering the trade. Once receiving the premium, your goal is to wait out the trade to see that premium vanishes so that you get to keep the entire or a portion of the premium that you receive. Now, the width of the credit spread determined by the difference in the strike prices is crucial. Wider spreads will result in larger credit amounts received, but also come with a higher maximum loss potential. On the other hand, narrower spreads may have lower credit amounts but limit the potential loss. Finding the right balance is key. As traders, it's essential to consider our account size when trading larger or wider credit spreads. While they can yield significant returns, they also require more capital to withstand potential drawdowns. So we should always be mindful of how much capital we allocate to each trade to avoid overextending ourselves. Risk management is the backbone of successful trading. A proper stop-loss strategy is essential to protect your portfolio. Whether it's based on technical analysis, fundamental analysis, statistical analysis, or a set parameter, having a well-defined stop-loss plan helps us navigate turbulent market conditions and keeps our losses in check. Now you might wonder, how effective are put credit spreads in the real world? Well, let me share with you the results of a backtest research study that I conducted from 2018 until 2023. During this period, I analyzed 75 trades only using $1,000 of capital. While returns varied across different market periods, I saw positive returns in most of the years, with the highest being an impressive 85.9% return in 2020 to 2021 during the COVID drawdown. But just like with any other strategy, it's crucial to remember that past performance doesn't guarantee future. However, by incorporating diligent risk management and continuously learning from the markets, put credit spreads can potentially deliver returns on par with or even exceeding the performance of the major indices like the S&P 500. If you found this personalized video helpful, consider giving this video a thumbs up and subscribe to my channel for more. Don't forget to hit that notification bell to stay updated on future content.